pleasure to be here. It's always great to be back in Vancouver, and another great visit. So thank you. What I'm going to do in this lecture is reflect a little bit on the use of evidence in drawing up ideas for tax reform, and kind of give you a feel for that. So what I plan to do is look at the use of evidence in thinking about improving the tax system. And I'm going to take the Mirrlees review as a kind of leading example, because that's what I was involved in. Some of you have heard me talk about it before. Well, it was a lot of effort, so I've got to make something of it. But there's a lot of material in it, and if you want to read more about it, if you haven't already, then there's a whole website of the book is online and free, of course, open access. The idea there was to get a kind of integrated picture of tax design and tax reform, and that's what I want to look at. In particular, I want to think about how evidence was used and how we might even develop further from that. The idea of the review was to get a comprehensive review of tax reform, picking on new evidence, new theory, new economic environment. Of course, in some sense, the history of the review was that it was 30 years since the Mead report, which was the thing that really started the Institute for Fiscal Studies, where I spend half of my time, and where we basically ran the Mirrlees review. And over that period, we've seen a lot of evidence, a lot of new data, and some new theory, and we wanted to reflect on that and the new economic environment. In fact, when we were about to publish, I was saying to people at lunch, suddenly the financial crisis arose. We thought about this review in 2006-07. We started it, and of course things were all hunky-dory in the economy, and we thought, right, we'll time this for the 30-year anniversary of the Mead review, and that also timed with a huge financial crash. And I thought, well, we might as well, delay this completely. But in fact, what's happened is the pressure on kind of government revenue has made tax reform even more salient, certainly in the US and the UK, if not in Canada. So perhaps you've been a little lucky and protected, but there's plenty to think of there. One message of the review is thinking about the tax system as a whole, and that's going to be a theme here. I should add this is a completely non-technical kind of overview talk. The review itself was looking at earnings, direct taxation, savings, capital, corporate taxation, environmental taxation, trying to think of the whole grouping of that and how we bring those together in reforming. And that's quite important, and I'll play on this idea quite a bit. If, for one good reason, when you think about the way reform is often discussed in political circles, is kind of tweaking little parts of the system. And of course, what we've ended up with in most economies is a set of tweaked reforms over a period, which makes the whole tax system itself, pretty difficult for anybody to understand, in particular the agents involved in it. So complexity, salience, and all of that become pretty key in reform. And I'll look at that. The idea of the review was looking at a modern, developed, open economy. The UK is the kind of running example, but we're certainly thinking about reform in countries around Europe and North America and Australia, New Zealand, all those kinds of economies. Not for developing economies particularly. There are different issues around the collection and what you can and can't tax. We're thinking of modern economies which have a reasonable set of tax instruments, and how you would think about reforming and using those. What about the increased evidence base? What are we drawing on there? Things about the labour market. We've learnt that the way people respond in the labour market is different types of people respond differently at different margins. There's been a lot of weight put on the distinction, perhaps too much, between the intensive and extensive margin. That's whether you're in the market or not, and how much you do when you're in the market, whether it be a firm going to a market or, in this case, a worker thinking about what market to be in and how much to work. We know that responses differ hugely by age and demographic structure. And perhaps that's something I'm going to draw on a bit more here, because I think once you start thinking about other aspects of the way tax system affects behavior, in particular human capital accumulation, for example, then a lifetime view and how the tax system affects you over your lifetime is pretty important, and I'll play that up. One other thing that's become available and become part of the whole debate is the way taxable income itself responds to tax reform, particularly at the kind of top of the income distribution. As taxes get reformed, top tax rates, how do people respond, not just in their earnings, but in their tax shifting, the amount of tax they pay. And there's something to be learnt from this, and I'll spend a little bit of time thinking about how we might bring in discussion of the whole income distribution and use tax return information. Of course, now we've got our hands, typically as researchers, on linked data from tax returns, whether it be Canada, the UK, the US, and so there's been a huge amount of evidence coming out of that. I'll try and comment on that. We've learnt a lot about how consumers respond to indirect taxation, GST and VAT and what have you. And in particular on intertemporal responses, we've learnt some things, lots we still don't know about the way human capital investments respond to taxes, earnings, consumption, saving, pension. I'm not going to be able to cover all of this, so I'm going to pick on one or two things, think about how we learned about those, devise reforms, how we think about reform there, and then come back to the whole package at the end. Of course, the other thing that's happened is just our ability, as I said, with taxable income, but ability generally to simulate and understand reforms at the detailed level using huge data sets on firms and workers and families. And I'll look at that a little bit. So the review had, it wasn't just economists even. There's, it's chaired by Jim Mirrlees, political economist, Tim Besley, myself, tax law economist, tax lawyer, top tax lawyer in the UK, Malcolm Gami. So there's a lot of weight put on implementation. Not everything in the review is immediately implementable, as we found to our cost to some extent. But nonetheless, we worried a lot about how reform would be implemented. So tax administration mattered. We wanted a kind of international perspective here, and Jim Patoga, who directs the MBR, was involved in that. So I'm going to use that as our background. There's a huge number of other people involved. I'm not going to spend too much time on going through every detail of that. What I'm going to do in the talk is also draw on some new material, just thinking about new ideas and things that have happened since. There are kind of three papers that I've been involved in. One is looking a little bit more detail at these different margins of behaviour. I'll at least give you some evidence from that. The other is actually, those of you, some of you were in the audience at the Canadian Economics Association meetings a couple of years ago, where I started thinking about how we put together the evidence for tax reform, and there's a paper come out in the CJE and a response discussion by Kevin Milligan, who and that's kind of handy, at least for me it's very useful, because he brought in some of the reflections on the Canadian tax system as well, and that's a useful thing I'll draw on a little bit here. And then finally, more recent work on thinking about some of the longer-term aspects of tax reform that we worried about in the review, but we had relatively little evidence. And one aspect of that I'll be thinking of here is on human capital, because it's relatively difficult to get a good idea of how capital investments vary or respond to tax reform, and yet it could be pretty key, and I'll try and bring some evidence there to bear that changes slightly your view about the way taxes affect behaviour. What about the background here? Well, a few of the kind of outstanding, the beginning principles, in a sense, of the review. This is very broad brush, but generally think about a system, and you'll see how this works in a particular case I'm going to look at. But you want to consider the tax system as a whole. A marginal tax rate is the sum of all additional taxes paid when income increases by $1, say. And you want to think about all the different ways, the tax, welfare system, all the things that affect the effective tax rate on behaviour. And then putting that in one place, you can see that particular taxes, you don't have to have all taxes to be progressive to have an overall progressive system. You don't have to have all taxes to be green to have a particularly green tax system. So once you start thinking of the thing as a whole, you might think that's a really obvious point, but as you look around the tax system, you see lots of bits of the tax system all trying to be progressive. And in a sense, that's kind of unnecessary. Once you think of the whole, there are more effective ways of generating redistribution through some taxes than other taxes, and it's unnecessary to have them all be progressive. Neutrality, kind of obvious principle in taxation, also an obvious one you might not want to adhere to all over the place, but nonetheless, the idea that it's unwise to discriminate unnecessarily, at least, between similar activities seems a reasonable point. And to give you an example, when you think of the taxation of different forms of remuneration, whether it be through capital gains, dividend income, investment income, earned income, we tend to have very different marginal rates on those types of incomes, and that can be a very dangerous thing to do. It makes it very easy to shift income, or if it is relatively easy to shift incomes about, you can see how much of the behaviour that occurs is just a matter of shifting across very similar activities, just in response to tax differentials. And then finally, progressivity, more tax from the better off. That's a kind of set of reasonable principles, one has to agree, I think. When you look at the tax system that we had and still have to some extent, I'll point out some of the successes of the review. We've had some impact, at least in the UK, but most of these things are still the case, and they're certainly the case as you look around other economies. Typically, the tax system doesn't work as a system. There's a kind of lack of joining up between welfare benefits, personal taxes, corporate taxes, and I have something to say about that. It's not neutral where it should be. There's kind of inconsistent differentials across different types of assets, different types of corporate finance, whether it be debt or equity, which typically lead to incentives that are unnecessary and tend to raise less revenue than you would otherwise want. It's not well designed where it should deviate from neutrality. There are lots of examples of where you would like to deviate from neutrality, and a good example is just looking at the different ways that carbon, if you look at the effective rate of tax on different uses of carbon, we have some beautiful pictures in the review showing hugely different rates of effective rates of tax across different uses, whereas there's kind of one externality there, much of it coming from worrying about progressivity and other things when you should be doing that in other ways. It doesn't always achieve progressivity efficiently, and one obvious case, certainly in the UK and many European countries, is the kind of narrow base of VAT. The UK has the narrowest base of VAT, in fact, in Europe. Many consumption commodities are completely outside the VAT system. Of course, there's been a huge pressure to increase VAT rates. Now in the UK, it's around 20. In many parts of Europe, it's VAT rates are around 25%. And differentials where you have zero rates on a large subset of commodities can be pretty damaging in terms of distortions. Of course, they're there for a reason. They're there typically for a reason of redistribution or other forms of other issues around progressivity and redistribution. But there's no real reason to do that. There are much more effective ways of achieving progressivity, and we spend a lot of time in the review on that. That kind of gives you an idea. I'll run through just broadly the kind of set of proposals, then I'm going to dig a bit deeper to kind of get some real solid material here. So treat the system as a whole. What do we come up with there? Well, one is a single integrated benefit. That is, I think it's true even in British Columbia. I was talking to Kevin the other day about that you can, there's a huge overlapping array of different benefits and tax credits, and one can imagine integrating those. And we come up with the idea of a single integrated welfare benefit. It's a kind of obvious point. Interestingly, it's now been implemented in the UK, and I might talk a little bit about its implementation, but I'll discuss that a little bit. When you have lots of overlapping benefits, you get some extremely high marginal tax rates through fairly aggressive means testing and overlapping. And that might be reasonable, but it might also be unreasonable. And one reason and one idea is to look at that a little bit more carefully, and we certainly come up with good reason to have less aggressive means testing here. And another one, in thinking of the system as a whole, aligning rates across employment, profit, different forms of income. Moving towards neutrality, I'll come back to these. Sensible deviations from neutrality, and then kind of going for progressivity through the direct tax and benefit system. So that's a kind of set of proposals. I can't really discuss them all, and I don't want to do that here. So what am I going to think about here? Well, the idea was to kind of use this lecture a bit more to reflect further on the use of evidence in thinking of tax reform. So how should we assemble empirical foundations for tax policy design? What have we learned so far? So what I do here is think of this as under 5 kind of steps. These kind of 5 steps to heaven for some very bizarre person like me who thinks that heaven is getting these kind of policy design right. I'll go through these in detail with some examples, because what I want to do is kind of use these to set up an agenda for reform and kind of take you through the way we think about that. Thinking of where is it that individuals and firms and others are most likely to respond. So where are the key margins of adjustment? That's the kind of way you start, looking at the key facts. Once you've done that, you think about what are the underlying incentives that are created through the tax system when you think of the tax system as a whole. Of course, as an economist, you think of the tax system as a whole, but individuals may not see it quite that way. Some taxes are more salient than others, some are better understood than others, so you immediately have to worry about the importance of information, complexity, and those issues. Once you've got that in place, you can kind of think a little bit more about trying to figure out exactly how individuals kind of causally react to tax reform. So what's the what is the size of responses? Are some types of activities more responsive than others? And that's where, in a sense, the kind of key statistical and econometric work comes in. Then you can bring all that together and think about the implications for policy design. So that's what I want to go through. I'm going to use these to build an empirically based agenda for reform. So I'm thinking here of a kind of efficient redesign of tax policy, not necessarily raising a huge amount more revenue, but raising that revenue more efficiently. And as you want to raise more revenue, of course, it becomes more important to get the design right. Great. So let me start with key margins of adjustment and reform. I'm going to focus here, as it said in the blurb, on earnings taxation of labour earnings, labour income over the lifetime. That's where, in a sense, a lot of the taxation is done. And it's also an area where I do empirical research, and so I can kind of think about how we brought these ideas together. This is the kind of descriptive analysis you start with, the key facts. Where is it that individuals, families, firms, where are they most likely to respond? where's the key margins of labour market adjustment? So here's a picture that doesn't have Canada on it, I'm afraid. I did try and do this, but it hasn't. But it's a picture of employment across 3 economies, just by age, in a year just before the onset of the recession. And it's a kind of key part of thinking about where responses occur. It's kind of important, and it was a little shocking to me when I first saw it, in fact, because this is the UK, it's France, the UK, and the US, and this is employment by employment of men by age. And one thing that's striking is that, if you can see the axis at the bottom, this is age. Between, say, around 30 to early 50s, there's almost indistinguishable the average employment rates across those 3 economies of men. And you might that's pretty shocking, given we all thought that the French, of course, work much less than the US, much less than... But in fact, they're strikingly similar. What's also strikingly the case is the effective tax rates on those employments are quite different. So one thing you might worry about is getting much of a tax response in the middle of that life cycle from these guys here. And in fact, a lot of kind of microeconometric work tends to often look at exactly the wrong place. You know, we say, oh, there's no effect, you know. Of course, when you look at this, you can see if there is going to be any action, at least on average here, it's going to be at the beginning of the life cycle than at the end of the life cycle. Obvious point, people have made it. But it's pretty key here. This is a fact. We might be, of course, it's not the case, probably not the case, that taxes, welfare or whatever, explains even the major part of these differences. We can't say that at this point, but the descriptive evidence is clear, at least where you might start to look. And that's one thing. What's surprising is it's also true for women. In gender, for obvious reasons, gender differs in terms of employment profiles. It's not quite so close, but one thing... But again, the big differences are either end of the life cycle. Another thing you can see here is that what used to be a rather M shape in employment for women, i.e. that it dipped around the periods of fertility, is much less clear-cut in more recent data. So employment will vary with children, of course, but you can see the similarities here. It's kind of interesting. That's employment. In fact, hours are rather different. There's lots of measures of how much effort people are putting into their work, of course, and hours is just one simple margin, but it's an important margin. And this is true for men and it's true for women. One thing that is the case, that hours of work in the US is the kind of outer envelope, more or less, of hours of both of these countries. So in work, on average, there are longer hours in the US than in the UK, than in France. And that's the kind of margin where you might think there's some action. Again, it may not be taxes, it can be lots of other things, but at least it points to something going on. And again, it points that, well, you might worry about the extensive margin. You should worry a little bit about the other margins where people can react, and this would be one. It's a little bit of kind of facts. The other thing we know is that education matters in many different ways. This is a rather pathetic picture of employment by men by college and less than college in the US. It just shows that generally, among men and women, attachment to the labour market is generally lower and, of course, falls off earlier in the life cycle among lower educated groups. This isn't a life cycle of a particular person or even a code. This is just an average across a particular survey. But it gives you an idea of what we might expect. Again, just interesting facts. The other thing we know, and here's getting a bit closer into the human capital debate, is that when you look at returns, that is just measured by hourly wages, for example. This is hourly wages of US men with some college, high school dropout. You can see there's a much steeper profile, at least on average, among those with college, and it peaks a bit later. It goes on, it goes up steeper, and it stays up longer. Right at the bottom of the education distribution, it's pretty flat, and if anything, declines. Of course, there's nothing. This is just purely descriptive, but it tells you something. You can see this in lots of other data sets. This is one that I've explored a lot, which is in the UK. But here we've got the same groups, basically: college, high school, less than high school completion, 16 in the UK. And you can see that this just raw profiles. For women, it's much more complicated because you're going to have periods out of the labour market, and I'll reflect on that, and taxes can affect that. But you see a much steeper profile, of course, coming in later among those with college than those with high school. And those with who've left school with effectively basic qualifications have a pretty flat profile. And one thing that's going to be clear from this is the experience effects through their lifetime, through their time in the labour market of the lower education group are just smaller. The payoff to work experience, if you go into work with relatively low education qualifications, is relatively low, and it increases with your level of education. So there's a kind of complementarity between the amount of education you have and the payoff to investments in human capital and work. That, you might say, well, what's that got to do with the way taxes affect behaviour? Well, it can have an important effect, because clearly for the guys with college, the cost of taking time off just because they happen to face, for example, a high tax wedge or a high disincentive are particularly difficult because they're going to lose their human capital investment. And so the action for those guys is not going to be in dropping in and out of work year by year. It's going to be on the careers they choose and the length of time in those careers, and you're going to see that. And so you want a bunch incentive. You've got to worry about incentives around that, in particular out in the kind of long horizon of those careers. I'll come back to that. Of course, women's employment is particularly key here. And another thing we know is that as you go up, this is the UK, but you see similar things elsewhere. If you go up the education distribution, employment rates are much higher and hardly dip for the educated, but they dip quite dramatically among low educated. Again, it's kind of in some sense less costly to take time out there. Moreover, at least in the UK and to some extent in the US and elsewhere, low education tend to go back into work in part-time work. And you can see the top group here, the highest degree of part-time work, is among lower educated. And that's going to be quite important too. One thing that's going to happen here that we have really discovered more recently in all the work on human capital investments is if you have low education and you do part-time work, the payoffs are very, very low in terms of human outcomes. And so that's going to be pretty important here. Summary of key facts. Of course, there's many others, but these are ones I want to put together. What have we got? You should take a lifetime view of employment and hours. It looks like that. Differences are accentuated at particular ages for particular groups. That's going to be important because where people respond is where taxes can be most damaging, if you want to think of it that way. High attachment to the labour market for high educated, so career length really matters here. And of course the education investments at the beginning. Wages grow stronger and longer over the lifetime for high educated, and human capital accumulation during work is shown is complementary. There's some evidence from that old experiment of the self-sufficiency program in Canada, which I'll point to. It's an old program, but it's kind of nice because it was a randomized control design, and it gives you some kind of some interesting evidence on this point, that among low education, the return to experience looks low, and you'll see it in the data there. I'll show you some pictures there, some of my Canadian data. It turns out to explain those pictures of wages, and in a way that's the kind of work that's been happening more recently, you really have to bring in a human capital model. It's impossible to get those really high, steep profiles of wages in a model or in trying to understand behaviour unless you have a payoff human capital during the career. Of course, other key facts, one of the most startling and important is just the huge growth in inequality, and in particular the huge surge of incomes at the top of the distribution. And I'll come back to that, of course, when we're thinking about top tax rates. And it's happened in Canada, of course, just like it's happened everywhere else. Not quite as dramatically, but actually pretty dramatically. I was looking at, I'll show you some figures which you've probably seen from Mike Veal's recent papers on that. But effective incentives, precisely how does the policy, so we've seen some descriptives, but now we've got to link what we've seen in kind of actions in the data. What's the kind of treatment? What's the effective tax rate here? With kind of overlapping taxes, tax credit, welfare benefits, we have to, what's the true effective tax rate? I think this is pretty important. In fact, some pretty good applied work often goes horribly wrong here just by looking at kind of one tax with ignoring the fact there's a huge pileup of different taxes. A good example is this US picture from the Urban Institute. I happened to be talking in a talk where there was Urban Institute guys there, and this was a picture that I used here. Of course, this brings in just all the different ways that the US system transfers income and taxes across low-income individuals, Medicaid and child health insurance programs. But right down here is the earned income tax credit. And you often see papers kind of looking at behavioral reactions to earned income tax credit as if there was nothing else going on. But there's a lot else going on. And so if you want to get things right, you have to figure out what they are. Of course, we're going to come back to the idea that, well, if we find it difficult to figure out, then surely these people are going to find it difficult to figure out. And of course, many of these things they're eligible for just don't get taken up because they're just too difficult to figure out, or perhaps too stigmatized to be worth picking up. It gives you a pretty unusual, but not necessarily horrible, set of marginal tax rates. In the US, you can get households which have effective subsidies at low income. There's nothing particularly non-optimal about that, as we know. But some of the shapes here are going to be, we're going to argue, are pretty unlikely to be efficient design. And I'll come back to that as I'm going through this. Of course, in the end, you want to put a budget constraint together and see how it moves across people and see how they react to it. Here's the US one. You know, there's earnings here. And the darker blue, but not very dark blue line, the flatter one is the kind of net budget constraint after you put everything together. That's the kind of effective budget constraint. It may not be exactly the effective one for everyone because they may not, of course, understand exactly how these things work. In Canada, as far as I can tell, there are a lot of overlapping refundable tax credits. In fact, when talking to Kevin, I discovered that in BC you can have 9 overlapping benefits that are related just to children. I'm sure it's pretty difficult to figure them all out. I couldn't figure them out at all, but I got this. And if you look at the in Kevin's discussion of the Mirrlees review, he kind of gives you the rates by province, exactly as I would just describe them for the US. And you can see that there's some pretty interesting and variable pictures on effective marginal tax rates. And they differ quite a bit across provinces here. This is for a family with 2 children. And incredibly, this doesn't include social assistance. And it doesn't say, I couldn't find anywhere at all where I could access the integration of social assistance with refundable tax credits and taxes for Canada on a picture by different types of, although one could do it with a good tax simulator. But it's kind of interesting. So, of course, you're going to have much tougher rates down at low incomes as social assistance gets taxed away, which isn't in this picture here. In the UK, a typical single parent, or parent actually, on low income would have a rather bizarre constraint as well. It's got a big jump up, which is tax credit coming in to try and get you to earn something. I'll show you how that works. It's got a very flat tax effective tax rate of 100%. That's the tapering, the withdrawal, the tapering, the clawback of social assistance in the UK, income support, which I didn't have on the Canadian pictures. Probably going to look rather similar, actually. A bit of earnings disregard, then a heavy taper until you run out of that social assistance. And then you get, of course, a flattening. That already looks pretty horrible, but of course what's really going on under there is just lots of different benefits and tax credits all coming together to give you a top line. There's your earnings, there's child tax credit, and then there's the child tax credit is the big one. So this is for a parent, minimum wage parent, effectively with 2 children. There's income assistance here, there's income support, there's housing benefit here, and then this says hours of work here because up until very recently, all tax credits were conditioned on a minimum hours, 16 hours. In fact, that's been scrapped completely from next year. But up to now, there's been that. And one thing you can see there is it gives a big incentive, at least in the UK, for part-time work. It turns out part-time work isn't such a great thing in terms of a human capital progression, for example. And that's going to be one important lesson from this. But you can see a pretty complex thing going on here. It gives variety of effective marginal tax rates by different household types. The high ones are all low-income families, this by employer cost. So this is everything going right down to the cost, the extra pound or dollar that costs the employer to employ you, the kind of whole wage, if you want to call it that, with everything packed in. The high ones, of course, are families, low-income families with children, where you want to give you want to redistribute, and then you're going to claw back. And the question is, is this a sensible design, or do we think it could be improved? And that would be, because there are tax rates at the effective margin, there's also tax rates at the extensive margin going in and out of work, and they're also can be quite high at particular cases, a bit like the replacement rate. So you could say the main defects are that participation tax rates remain very high, UK and elsewhere. Marginal tax rates in the UK and elsewhere, we saw that for the US and for Canada, can be well over, can be high, 80%. It's a kind of complex cocktail of different overlapping benefits, all with kind of a good idea behind, but complicated. What about tax rates on top incomes? Well, they can be equally difficult to figure out. There's a kind of headline federal tax rate or income tax rate, but of course there are other things. In Canada, there's provincial tax rates. In the UK, there are other effective tax rates on employer. For example, if you were to, take a job in the UK, they'd tell you about the blue line, which is the income tax rate. Looks pretty weird anyway. It has this jump up to 60. This is hundreds of thousands of employer cost, So quite high. There's a jump up here, which is to do with tapering out the personal allowance. Then it goes along happily at 40, then jumps up to 50. That's just been reduced to 45. There's a lot of controversy about how high the top tax rate should be and where it should be set. But of course, when you add in national insurance contribution, which is effectively a tax but paid by a combination of the employer and the employee, it jumps up further and looks a little flatter, but doesn't look very reasonable, at least the jump up to 60+% in the middle of the distribution. But you can see these, what appear to be relatively lower tax rates down here, are relatively high when you add in the full national insurance contributions. When you put all those together, you kind of ask, well, what do we know about information and complexity? I guess there's two kind of bits of evidence that we certainly used in trying to figure out what's going on here. One is how do people take up these different kinds of benefits? What does it look like? If someone's eligible to this particular tax credit, what's the chance they take it up? It is true that among the refundable tax credits in Canada, I think the take-up is pretty good. If people understand it, they take it up. Another thing you can do is look at bunching and see whether people really do appear to figure out. Of course, difficult to unpack from their actual responsiveness. But do they figure out the way the tax system is working? So the first thing we know generally is true, that as you become eligible for more as more valuable a benefit is to you, this is tax credits, working tax credits, EITC, like the working income tax credit in Canada. As entitlement increases, this is pounds per week. This is back when the system was changed. You can see this is the average probability of taking that eligible benefit up, and you can see it increases strongly from quite a low take-up to quite a high take-up, never getting quite to 100%, so there's some that just don't take up what appears eligible. We may, of course, get their eligibility wrong, because after all, we're not exactly sure we're measuring that precisely right. But you can see it's important. So we write down that effective tax rate in the picture, but if you don't take it up, then it's no effective tax rate. And so the degree of generosity of a system changes the effective tax rate of that system in an important way. And if you ignore that, then you're bound to get responses incorrectly measured. What about bunching? Well, here's a popular picture of this is the earned income tax credit in the US. You saw the picture on that other, but the way it works is there's a subsidy in to a maximum amount. You keep that maximum amount and then it gets taxed away. 40% in, 25 out, I think. And it's relatively generous. It's the biggest transfer program, I think, at least for working people in the US. And superimposed on this from one of Emmanuel Saez's papers is the frequency of individuals at different earnings who are likely to be eligible for this benefit. And what we'd expect is that quite a lot of them would bunch at this first point because up to then you're getting a big subsidy. After that, you don't get a subsidy. You keep that amount, but it doesn't increase your marginal earnings by 40% like it did before. And then it's taxed away at a taper rate. And there again, you might expect people to bunch a little bit at the second one because after that, there's an effective tax rate. And so you look around for bunching. Of course, you have to be a little careful. And Emmanuel doesn't seem to mention this, but if you go back to the first picture I put up from the Urban Institute, there's a lot of other things going on to muddy this incentive structure of earned income tax credit here. And so it isn't quite as clear-cut as it looks. But it looks like there's some reaction to this, but there's also quite a lot of muddiness around those points. So it's not the case that it's kind of perfectly pointed to here. What's kind of nice that this particular study does is then break income into its pieces, and what you've got here is looking at bunching in self-employed income versus other income, and you see all the bunching is for the self-employed, and of course it may be they're devising their work effort to be exactly there, but it could also be that they're just managing to organize their incomes around that point. And this is, a lesson we learn is that lots of the responses we see, especially for self-employed and higher income groups, are about tax shifting. You can't say that's for sure here, but it gives you a little bit of an idea. It could also be that self-employed, of course, can respond, and we'll look at that a bit. If you look at the top tax threshold, you might expect the same thing, and there's a huge amount of work on this using, here's the UK, for example, using tax records. That's where the tax threshold comes in, and this is incomes below, incomes above, and you can see that there is quite a bunching just at the point where the tax rate goes up, what appears to be from 20 to 40, but if you look a little closer, it's not quite as big as that. And you'll see that. But nonetheless, there's some... So, people understand what's going on there. If you look a little bit more at what they're doing, though, and this is breaking the earnings up into different parts. These are high-income individuals, still a lot of earned income, but there's a lot of other, for example, dividend income. Turns out dividend income is the one that's most responsive, and it's pretty easy to shift your dividend income around or even translate some of your income into dividend income. So you have to be a little careful about responses here. And that's what I'm going to look at a little bit. In fact, if you look at the tax rates in the UK on different income sources, they're not aligned very well. The tax rate on dividends is typically lower, and the jump we're looking at is at 40,000, where the first jump occurs. And of course, it's much bigger, in fact, really looking at it for dividend income, because for other income, there's a little bit dip down and then a dip up because of the strange structure of taxes. But in fact, if you look at the top line there, maybe for earned income, the incentives are much less than for dividend income to place it in those places. So again, this is going to be very important in trying to figure out behaviour here. Kind of work out what the effective tax rate is. We're going to think about how people might respond. Then comes the kind of heavy work in a way, although I can't really see how you can do any of this heavy work without doing the first bit of work. And that's a kind of lesson you learn, but lots of people ignore it. You might go straight for this, that is you have a reform and you look at the response. Trying to untangle what's going on there, you really have to dig down into what we've just seen. How big was the effect? How did people understand it? There are kind of two approaches here, which many of you will know. I like both, different forms. You can imagine looking at historic reforms, a bit like we've been doing already. Just what does behaviour look like? How do people respond? And this is, if you're lucky, you might have some randomised controlled trials, or you might just have some relatively exogenous variation from some natural experiments of tax reforms on one group rather than another. It's kind of robust, but you can never really redesign a tax system from this. You're going to get little snippets of information, and they're pretty important, of course. What you do to figure out a tax system is you want to be able to simulate reforms, and so you need to put all these bits together and reflect on exactly the life cycle facts, the effective tax rates, salience and stigma. This is a huge kind of project to get this kind of work going well, and it's partly what the Institute is set up to do. What do we know? I'll go into a bit more detail, but this is what I think we know, is incentive effects. Labour supply elasticity is a bit like what we saw in the initial pictures, that's why I put them up. But they do vary a lot by education group, family type, and age. And that's going to be quite important for tax design. And experience matters, and especially for those with more than basic formal information, education, it's important to take account of the experience payoff. People are not going to react very at high frequency to taxes. It's just not worth it. And that's going to be quite important in trying to figure out what's going on here. We saw those steps. If you remember the Canadian experiment where a group of, this is the data from Vancouver, which I happened to get my hands on late in the day, but nonetheless, it's kind of useful. It's way back in the 1990s, and many of you here know this data better than me, but I think it is quite informative. It was a randomised control trial on welfare mothers, so low-income mothers, where they were offered effectively a time-limited tax credit for full-time work for 3 years as an alternative replacement to income assistance. And you've got a treatment group and a control group. The red is the experimental treatment, the blue is the control, and this is the months since assignment, so they get 12 months to be assigned. They can jump in at any point. After 3 years, they're rolled right out of it. It just stops. And the one thing you notice is that it has a big effect. This is on employment rates. Quite a big effect. They start the same. In fact, it's quite a reasonable design. They look pretty similar. Big effect on employment. So there's a lot more employment going on among this treatment group. They end up looking very similar in the labour market. Unfortunately, this experiment kind of stopped too early, but you do see people for a few months after the reform is over. What's striking is employment just suddenly gets back to where it was. So the beauty of a control group, of course, is that you might think it's still high, but the control group, kids age, people get into work, so you have to have a proper comparison group. If you look at hourly wages, this was the thing I remember that struck me most. It's in one of David Card's papers. But, by the time the program's over, the hourly wage rates are just back to exactly what they were for the control group. They're almost exactly the same. And in fact, I think in David's paper, the whole distribution looks like it lies more or less on top of. So all this extra employment didn't lead to any extra hourly wage. Kind of worrying. In fact, it doesn't lead to much in hourly earnings either. So this is where, you begin to get a little depressed, of course, to say the least, because it looks like, and this is the point, that, those with relatively low formal education and skills, the payoff to being in work in terms of any human capital experience is there, but it's very small. And the big payoff is among those with higher education. That means that these guys are more likely, of course, they put a much higher value on extra dollars. These are poor people, but also they're more likely to respond to incentives. In fact, they do respond here. You can see it. But they'll respond the other way too. Once the program's over, they go back to pretty much what they would have done anyway. So, that's just one example. It's not going to be enough to design a tax system, but it's kind of useful to use that evidence. The hardest thing that we probably, and we still haven't really got a good hold of it, is how taxes affect education choices and career choices themselves. The one thing I've learned is, of recent work, is it's not only the return, the average return that gets affected, it's the insurance value as well. And a good example of this is just to think about, if you just look at earnings among educated, of course they still splay out, but the chance of getting a very low wage outcome if you've invested in formal education is much lower than if you haven't. And so education kind of acts as an insurance against very low wages. But of course, so does the welfare system. And so if the insurance value of education gets reduced quite a bit if you have a very supportive welfare income assistance type of scheme. So tax credits and those kind of things, this is a kind of the downside, of course, of progressive taxation when it comes to human capital. But it's not just the average return. I found the insurance value, these are all risk-averse people. And when you look at all I've been able to do is follow cohorts coming into education and through education as taxes change in the UK. There does seem to be some action here. And it makes you you have to worry a little bit about these early human capital investments. We've seen information, stigma, salience probably matter. I guess what this says is an obvious point, that large and well-understood reforms are more likely to affect behaviour in the way you hopefully were designing it. And that's kind of obvious point, and there's plenty of evidence that that's true. Taxable income is going to be so... It's not just earnings themselves, but you might shift taxes around. So taxable income can be responsive, and it probably reflects tax shifting and avoidance often. It can reflect other more productive uses as well. More specifics. Overall, it looks like, taxes reduce labour supply, generally. Of course, there's offsetting effects here, but generally it looks like substitution effects are larger than income effects. And so if you increase tax, there's a bit of a reduction there. We've got precise. But where does it really matter? It matters for low earners, that's low wage, low education individuals. It seems to be the case that responses are larger at the extensive margin, employment, than an intensive margin. But still, and they're probably largest for women with children as they approach school age. That's true pretty much everywhere. And they're quite large. If you know the elasticity literature, you get numbers around 1, 0.9, and in the intensive rate margin still around 0.5. In contrast, if you look at college-educated workers, they're very irresponsive, very small reactions. And that can, of course, lead you to think you can just load up taxes on that group, but it's unwise to think that, of course, because you've got to take account of the human capital investment, both the career choice and the career length. And we've got some nice evidence on how that might work. What about human capital then a bit? There's kind of two forms here that we know about, schooling and then on the job. They're complementary, it seems. The hourly wages, as we saw, those with more education are higher. They grow faster and longer into working life. Formal education complements experience capital. And there's little experience payoff for those with low initial skills. You saw that in the SSP. It's really obviously the case. It's still a little controversial, but it looks key to me. For educated young workers, employment generates valuable experience. We know that from people coming out of college programs. And they're unlikely to respond to tax incentives during their early career. What they really do is think about career choice, career length. They're very hard to get right. The one thing we do know about responses is around retirement, kind of length of time in the labour market. And we know that incentives can be quite important there. And they're important for all these groups here. If you think about older workers, of course, responses just look much bigger among the 60-plus group, 55-plus, 60-plus group, and they appear to remain higher for women at both margins. It's probably something to do with the fact that, in a sense, it's still the case that there's a lot of high education women kind of coming through into higher participation rates at older ages. That's already happened for men, but it hasn't happened for women, and that's exactly where the kind of human capital payoff, it becomes important. If you also think about it, where we thought the elasticities might have been relatively small, of course, as we make behaviour, as we make incentives as we make working a little bit more actuarially fair in the Social Security and pension systems, that is, we remove earnings tests, which has happened more or less everywhere. We, in fact, make it less of a kind of a big cliff or a kink at the state retirement age or normal retirement age. Then elasticities are going to get bigger, and there's a lot of evidence of that. But still, other things matter. I was talking to someone earlier today about, it looks like even with those incentives in place, we still can't explain all of retirement behaviour. You can explain about 50% of retirement behaviour from incentives, but the rest is still a kind of puzzle. Joint retirement matters. There's a lot of, it seems like there's quite a lot of complementarity of leisure times among couples. Lower educated, responsive to disability, social insurance, medical insurance, particularly in the US. And higher educated, that's when higher educated seem to get most responsive. In a sense, they're way above the participation margin through their career, and then they come close to it. And it's also where some of the biggest disincentives and wealth effects, if you want, in the system happen. And that's going to lead to our reforms. Elasticities or responses are sizable, but they can't explain everything. If you try and make them explain everything, then they just look too big. And there's a lot of room for other kinds of behavioural model around retirement, I think. What about taxable income for top earners? If you think about this capturing avoidance and tax shifting, then the tax base, how all the things that, how big is the set of things you're taxed on and how easy is it to escape taxation becomes important. So responsiveness depends on the tax base. And for a given tax base, you can work out what if you want the maximal tax rate should be on top incomes that would generate the most revenue. That may not be in any sense the optimal, but think about raising revenue for a minute. That's called the Laffer rate, and it just depends in a fairly kind of nice way on two parameters, kind of well-known result here, but they're kind of nice. They're both empirical things because we're looking for the revenue maximizing rate. We don't worry about social welfare weights or anything. We're just trying to raise money here. And so this is kind of simple-ish thing to do. Depends on two things. One is how responsive people are in that top bracket, thinking of the top tax bracket, and how many people there are in that bracket. And if the distribution's pretty Pareto, then that just depends on the Pareto parameter, the number of people. and taxable income distributions are remarkably Pareto-tailed. The elasticities are a harder thing to get. How elastic is behaviour? If you look at the picture, this is just the UK, but this is the taxable income distribution, and the red line is the Pareto, and the brown line is the data, and it's pretty reasonably Pareto. And you can read off the A parameter there. In the UK, it's about 1.67. I think in Canada, it used to be about 2, but my guess is it's going down a bit because the distribution's getting more skewed. In the US, it's around 1.5. So bear those in mind, because if you think of the A parameter being, say, about 1.8 or 1.9, then you're thinking of the top tax rate. What would the taxable elasticity need to be? If it was about 0.5, then you'd start getting maximal tax rates. Maximal revenue maximizing tax rates of about 55%, which are interesting to do. In the UK, we judge that at the A we can measure pretty much. We have all the taxable income data. E, the elasticity, we went for around 0.45. It's probably a little on the high side, but I'm not sure about that. We don't really know about this number. Typically, for higher incomes, it's a higher number. And I remember the old Canadian results used to put this number way up around 1 or above, but they seem to have got smaller over time. But it's still the case for higher incomes. They're probably in this vicinity. If you put these numbers together, then you get a maximizing rate of about 55, 56%. You can see already the UK is up there at that point. So it's kind of depressing again that there's not much room for getting more revenue out of those guys. But you have to remember the very top line. It's all about the tax base. And typically what we're thinking of here is about tax avoidance and tax shifting. And so the policies typically are things about tax base first before you think about rates in this. And I was surprised looking at the Canadian data from Mike Veal's recent paper, where he reviews these tax rates as well, actually in a similar style. It's just how shockingly the jump in distribution inequality, this is the share of income in Canada in the top 0.01%, 0.1% and 0.1%. And you can see the top as in the US, the UK, and it seems in Canada you've nearly got a doubling of that share over a period of 20 years, which is quite unprecedented, I think. And so it does put a huge pressure on redistribution and a huge issue around what tax rates should be. I'm not going to spend too much time on that, but it's a fun thing to debate. My guess is exactly the same debate as we had my guess is that now the Pareto parameter is getting close to the UK, still a little bit larger. And if responses are around 0.4 or above, then it's going to be hard to think of tax rates going up much above 55, 50%. My reading of if you take the top federal rate and the top provincial rates, is you get into the top 40s, 50% of the top rate, which is still relatively low, actually. So there's some discussion there to be had about what top tax rates could be. I kind of like this because it's a very empirical thing, but I think you have to be aware of this issue about tax base. So 5 messages. I'll just round up and then open for any discussion anybody wants. But the way I look at this in this kind of narrowish field of looking at income tax, earnings tax, is that it's kind of key to take a lifetime view. I thought that when we did the Mirrlees review, I've become even more convinced looking at the kind of human capital side of things. It's kind of obvious. There are key points in the working life where incentives matter, and that's going to be very important. Where incentives matter, then you can get efficiency gains by redesigning the tax system. And it looks, if you just look at the UK and the US tax system, where incentives seem to matter, seem to be exactly the points where the tax rates are also highest, around retirement, and I'll give you some examples of that. Of course, you have to allow for the interaction of taxes, tax credits, welfare. We saw that effective tax rates depend on the whole system, and then we have to worry about information. information costs, stigma, fixed costs of work that make extensive childcare costs, make extensive margins different from intensive margins. Human capital matters. Education investments enhance human capital at work, and incentives for education investments are influenced by taxes, obviously. And then taxable income is capturing these avoidance and shifting opportunities. That's the kind of set. There's a lot more detail there, but that's the way I kind of read what we have here. And implications for redesign. I think it's kind of clear that, to me, that the systems, wherever you look at them, are unnecessarily complicated, and they clearly do induce too many people not to work or to work too little. Just looks like you can redesign things just across people's lifetime that would make just enhance. In fact, in the review, we do suggest a set of explicit reforms of that kind, some of which have even been taken up in the UK, which are just redesign over the life cycle of incentives. It's not really making them age-based, as some people have argued. It's really just making them more neutral, in fact, because a lot of the high tax rates, high means-tested, effective tax rates, happen at points where the most responses are happening. And if you redistribute across the life cycle tax burden, you can do quite a lot. So you target work where incentives most effective. As I said, in simulations, we think about still looking at the flows into work of lower education mothers and maintaining work among 55 plus. That's where, in a sense, the gains are. I'd like to think we knew a lot about how taxes affect school to work decisions, but we just don't know enough about that. But that's the other area where it's going to be important. You think about integrating. We had, in fact, in the Mirrlees review, we came up with the integrated family supplement, the IFS. And what in fact got implemented by the government was what's called universal credit, which puts all, the original idea was to put all benefits together under one heading, exactly as we suggested. Unfortunately, it didn't really happen that way. So suddenly one benefit gets left out, another benefit gets left out, and then, and also, of course, at the same time, because of the squeeze on revenue, there's a tightening of the amount of expenditure. But nonetheless, it's a similar reform to the one suggested here. And the idea was pretty simple, just to reduce this overlapping of taper rates and clawbacks and make take-up easier. And that's kind of nice. Among the educated, you think of the career profile. So, not bringing you want incentives among for human capital and capital investments are really a long-term thing. We need to understand a bit better how that is perceived by individuals, but certainly in simulations we've done in that latter paper that I mentioned, there's some action there, and you have to be very careful about that. And again, it's a life cycle kind of redesign here. And I guess, this is something we know. Many tax reforms are going in this direction. For the top tax rates, I think of this as an alignment issue. You want to, it's effectively at least be fairly neutral in tax rates across different sources of income to at least avoid obvious tax avoidance and shifting possibilities. There's also, when you look at the distribution across life cycle, you see taxes are doing a huge amount of redistribution for individuals and families across their own life cycle. And of course, we can, if we thought that's what taxes were doing, then we could resign it much more efficiently just through social insurance. And I think there's still a huge role for rethinking social insurance and welfare accounts, whether I'm sure they're just going to become a more topical part of tax reform. Shape of the overall package then. Well, back to the beginning. So you can see in a sense where we got the idea, single integrated benefit and incentives where, target taxes where incentives matter, response elasticities. Things I haven't talked about here was broadening the VAT base, very controversial, something we've had absolutely no success in persuading anyone. Although in Europe, of course, what's totally bizarre is that, you go to Denmark, which has a very broad base at 25%, is one of the most redistributive economies in Europe. So even though And so it's, having a broad VAT base doesn't mean to say you can't redistribute fairly effectively, and we spend a lot of time worrying about that. On capital taxation, which ties in with earnings taxation, it's about alignment. We try and align marginal rates, so it makes it much more difficult for people to kind of reassign their income from labour income to something else and get a lower effective tax rate. Again, that's quite controversial, but we come up with a system of how to think about doing that. And of course, there's issues around other kinds of capital, like housing and capital of that kind. Pensions, it just looks like incentives really matter, but they don't explain everything. And there's clearly some. And when it comes to these long-term saving incentives, you have to allow room for other kinds of more behavioural parts of the tax system. And so twisting implicit incentives to retire at later ages is going to have an important impact here. But it's not the only thing that's going to work. Aligning tax rates, well, this is where you think about the top tax rates, but limits. It looks like there are limits to raising taxes at the top, but it's an empirical question. It's been difficult to get a really good idea. But one thing that is clear is that it's kind of easier if you remove avoidance and tax shifting opportunities, and there's really no particular loss to that, I guess I would argue. You may not still want to raise top rates, but doing these kind of things is important. And when you think about that, then you get into the system as a whole, because of course you're immediately into the way you think about taxing dividend and corporate income. And in the review, we spent a lot of time getting all those things lined up in a way to reduce incentives. We provide a lot of evidence that, for example, corporate form, whether you're incorporated or not, is hugely affected by relative tax rates, and that's going to be important here. If you've got that in place, then of course there's less need for anti-avoidance measures because there's just less opportunity. That's the obvious point. But I think I'm going to end there because just could go on forever. And so the idea was this kind of 5 steps to kind of thinking about evidence in reform. And I've kind of been thinking about this since we did the review, and this is the way I'm going to put it together. And I hope what I've done here really is to kind of say, well, if you think about these steps, it kind of gets you closer to kind of having a real evidence-based kind of policy base for reform. And let me finish there. If you want to read more, of course, it's on the Mirrlees website. So thank you.